Hi, welcome back to Money Management Part 2. Here I want to go over some concepts of risk within any type of investment. And after I go over explaining some of the risk, what I want to do is show you a little bit how to allocate your resources properly. Exposure to risk. With any investment, there's always an exposure to potential risk. It's important. It's vital to recognize that fact so that you can remove unrealistic expectations of the future, which could harm you financially and emotionally. Let's say, for instance, you only have $10,000 and you're saying you're going to be a millionaire with that investment of $10,000, but you're putting it into a risky stock and you think that you're going to receive 137% interest annually for the next 5 years. That's unrealistic. Not saying that it couldn't happen, just the likelihood of it happening is almost non-existent. So removing that unrealistic expectation and becoming more of a planner, so to speak, it would help reduce that exposure to risk. In the next couple of slides, I'm going to address 3 different types of risk. And from there, you can brainstorm ideas on how to manage the risk in your money market investments. The first kind of risk we're going to talk about is credit risk, the risk that a borrower may not repay on time. The loss that you incur from a borrower defaulting on its payments is that you may only get a portion, if any, money back on your initial investment. There are some institutions like commercial banks that are insured on people's deposits up to $250,000, and the insurer of the commercial banks is the FDIC. I want to take a second to get you thinking from the perspective of a lender and transition the conversation a little bit over to credit scores. A credit score from a banking perspective or a lending perspective of organized institutions is a measurement of risk. So someone with an 850 credit score is deemed to be virtually riskless when it comes to lending, compared to someone with a 400 credit score who's deemed to be very risky. And to offset that risk of lending to someone, if at all, to someone with like a 400 credit score, banks jack up the interest rates to offset that risk. And if you look at it from the perspective of a lender, being you're the person that's investing in the bank or in a company, you'll start to recognize why there is that barrier there to severely limit the ability of someone who's unable to pay access to credit. The second type of risk is interest rate risk. This is the risk that interest rates will change on the market. A prime example would be a treasury bill that initially has 4% interest on it. Within a few months, the market's now offering treasury bills with 10% interest rates on it. Your bill that you're holding with 4% interest now becomes less valuable than the one that has 10% interest on it. So to offset that loss of interest that a purchaser of your bill would have, they would want you to sell them your bill for cheaper. The last type of risk that I want to talk about is liquidity risk. This is the penalty that you're hit with as a result of converting your assets to something liquid. An example is a CD or a certificate of deposit from a bank. If you want to pull the money out early, say 3 months early, 6 months early, you're going to be hit with a penalty for trying to convert it back to cash. Remember, your situation's always unique. And to invest in anything, you have to understand your personal comfort level with risk to return. Here, I'm not going to go into too much detail, but an interesting human psychology is that humans by nature are loss averse, meaning humans feel loss more highly or more intensely than they do good feelings. And the number is about 2.5 times higher than when somebody wins something. Below, someone's gambling and lose $50. They would have to gain 2.5 times that amount to feel the effect of that, to feel the effect of gain equally to the effect of the loss of $50. 3 rules for determining your prime money allocation. Anticipate your upcoming bills. Ensure that they're covered adequately. Use budgets and forecasting tools, as well as determining your liquidity ratio. Recognize the potential for unanticipated expenses. Car breaking down, the need for an oil change, things that need to be repaired in the house, co-pays that need to be paid going to the hospital, the $50 charge to go into the emergency room. You need to understand that. And always recognize your personal risk tolerance in investing. That's the end of part 2 of money management. The next course we're going to go over is credit management. Thank you for listening in. I really hope that you guys are learning a lot. Again, I look forward to seeing you in the next video.